Still trusting RSI alone to time your trades? That's exactly how smart traders take your money. RSI might show you a reversal. But is the market really ready to move? That's where ATR steps in. It exposes the real volatility behind the chart. In this video, you'll learn how combining RSI plus ATR can filter out fake setups and turn your trades from hopeful to high conviction. And stick around, I'll walk you through a real chart where RSI screamed buy, but only ATR revealed the trap. Let's dive in and change the way you trade. Quick explanation. Let's start with the basics. RSI measures momentum. It tells you if the asset is overbought or oversold. But RSI doesn't care about volatility, how wild the price is moving. That's where ATR comes in. ATR shows how much price is moving on average, whether the market is calm or crazy. If you enter based on RSI alone, during high volatility, you'll often get caught in false breakouts or premature entries. How to combine RSI and ATR. Buy signal. When RSI crosses back above 30, it shows the market is oversold and could bounce. But you want to confirm that the move has strength, not just a slow drift. To do this, check if ATR is higher than usual. On some platforms like TradingView, you can compare ATR to its own moving average, for example, the 14-period ATR average. If it is above this average, it means volatility is high, and the RSI signal has a better chance of working. To add a moving average on top of ATR in TradingView, simply add a moving average indicator and set its source to ATR instead of price. Sell signal. When RSI crosses back below 70, it means the market is overbought and could start to drop. But you still want to make sure the move has real strength, not just a weak pullback. To do this, check if ATR is higher than usual. You can compare ATR to its own moving average to see if volatility is elevated. If your platform doesn't have this option, just look to see if ATR is increasing compared to recent candles. Time frame recommendation. This approach works well on 1 hour or 4 hour charts. You can also test it on daily timeframes for swing trading. When to avoid RSI plus ATR signals. Not every signal is worth taking, even when RSI and ATR line up. Avoid trades when RSI gives a signal, but ATR is low or flat. This usually means the market lacks momentum, and any move that starts can easily stall or turn into a fakeout. Low volatility environments often trap traders in slow, frustrating price action. For example, in this chart, RSI crossed back below the 70 level. This is usually a sell signal. However, ATR did not increase, which shows there was very little momentum behind the RSI signal. As a result, the price moved sideways instead of making a strong bearish move. Quick recap. RSI tells you if price is stretched too far. ATR tells you if the market has enough energy to move strongly. When you combine them, you can avoid weak setups and improve your timing. Question: what happened the last time you trusted RSI alone? Have you ever wished you had checked volatility first? Share your story below. Most traders ignore volatility. Don't be like them. Start combining RSI with ATR and see the difference for yourself. And if you found this helpful, subscribe, because in the next videos, I'll show you exactly how to combine RSI with other indicators and build a trading system you can trust. See you in the next one.